thank you for joining us on this call to provide some perspective and some observations on both the investment markets as well as the economic markets. So I wanted to start by introducing Aaron Long of Strategas Research Partners and have him take the call to introduce our speakers, Jason and Don.
Well, Marty, thank you so much for having us on the call today. And I just want to thank you and the team at Westwood for your partnership over the years. Just to give a brief background on Strategas, Strategas has been ranked the top global macro equity research provider in institutional investor for the past 3 years in a row. The firm was founded in 2006 by Jason Trennert, Nicholas Bonesack, and Don Rissmiller. Currently, we work with institutional clients in more than 26 countries around the world and in 45 states. We have a diverse product offering across the macro landscape, and it's our pleasure to be here today. And it's my honor to be joined by Jason Trennert, the chairman and chief executive officer of the firm. In addition, he's also our chief investment strategist and is known as one of Wall Street's top thought leaders on the subjects of markets and economic policy. As I mentioned, Jason and Don co-founded the firm in 2006, which originally began actually just as 5 employees. Today, the firm employs over 50 research analysts, institutional salespeople, and sales traders, and offices in New York, Washington, and Washington, D.C. Prior to founding Strategas, Mr. Trennert was the chief investment strategist at ISI Group, where he built and oversaw 2 of the firm's most popular research efforts, its company surveys and investment strategy groups. Don Rissmiller is our chief economist and again co-founded the firm in 2006. He oversees our firm's thematic research as well as its high-frequency econometric forecasting. Prior to co-founding the firm, Mr. Rissmiller was an economist and managing director at ISI Group. And prior to that, he worked at the Federal Reserve Bank of New York, focusing on the analysis of U.S. macroeconomic data and price-wage forecasting models. So, Jason, I'd like to go ahead and turn the call over to you.
Well, thank you. Thanks very much, Aaron, and thank you all at Westwood for hosting this. I hope we can add some value here in obviously a very uncertain time. I'm going to make maybe 5 or 6 broad points. And I'll start out with kind of obvious ones, and then go to maybe a little bit more nuanced ones. And I'm going to turn it over to Don Rissmiller, who will go over some of his points, and then we'll try to leave plenty of time for questions. But we don't want to wear you out too much with prepared material because obviously it's such a fluid situation. First thing I would say is that, as some of you may know or may not know, there are kind of very specific definitions of recession from National Bureau of Economic Research, and then there's kind of this heuristic of 2 quarters in a row of negative GDP. And as far as the second one, I'm not so sure we may get. It's likely we'll get there, we may not. But I would say no matter how you slice it, we're already in a recession. We're looking at 10 indicators on a weekly basis. We're looking on a daily basis, but we publish it weekly to determine when expectations for global growth have bottomed. And right now, 5 are still deteriorating. So, I don't want to get too. The market seems to have found some sort of near-term bottom, but the economic situation, I think, continues to deteriorate. If there's any good news in this, and I know this is scant praise, one of the questions we get a lot is whether we're going to face a depression, and I feel very, very strongly that depression is very unlikely. The chances aren't 0, but they're low. And here the definitions are more difficult to to define. There's a very not any sort of specific definitions, but the main reason why I think a depression is extremely unlikely is that just comparing this episode, what we saw in the 1930s, the simple point would be that policy made things a lot worse in the 30s and have an ability to make things a lot better now. As you may know, the government has really four policy levers that they can maneuver: monetary, fiscal, regulatory, and trade. And in the 30s, I would argue that we made every mistake you could make. We went 4 for 4. We tightened monetary policy to stem an outflow of gold. We raised taxes, particularly on corporations. We tightened regulations, particularly on banks. And we had a full-blown trade war with Smoot-Hawley. That was in the 30s. This time around, obviously, everything is quite different. Fed's balance sheet is over $5 trillion right now. So the Fed is easing very aggressively, and it's going to be able to buy all sorts of assets it was never able to buy before legally. And so you've already seen that result in a tightening of some credit spreads. On the fiscal policy side, if you're keeping track, the big fiscal policy bill that we saw pass last Friday was actually the third fiscal policy bill that would pass. The other ones were much smaller in comparison, about $8 billion and $40 billion were numbers 1 and 2. This was $2.1 trillion. And it has an ability, because of the small business loan facility, to actually be another 3 or 4 trillion in actual stimulus because it could be levered up 10 to 1. So fiscal stimulus is pretty dramatic here, and they're already talking about a fourth fiscal stimulus package. The regulatory environment is also easing, particularly on banks, on the Fed, also as far as pharmaceutical companies and healthcare companies. So that's quite good. And even trade is something I wasn't expecting, but the Trump administration actually suspended import duties for 3 months from China. So it's not, it's not a complete cessation of the trade war or an easing or a lowering of tariffs, but still, I would argue it's a step in the right direction. So the first point is that we got a recession. The second point would be that a depression, I think, is extremely unlikely because this is a whatever it takes moment in terms of government policies, and we've learned the mistakes, I think, quite well of the 30s and are doing really moving heaven and earth to try to make sure this is not an L-shaped bottom. It remains to be seen whether this will be V-shaped, but I think chances are good this will be at a minimum a U, which means we get hit and we're on the mat for a quarter or two, but then there's a chance to come back. If we get really lucky as far as the health situation goes, there's a chance it could be a V. But right now, my best guess is a U-shaped recovery. We get so recession, but no depression. Then we get a question about what about the markets? My own opinion is that we've likely seen the low in the S&P 500. In most instances, when you see a bear market like this, you tend to retest the low. That tends to be quite frequent, and that can happen even after you rally 25% off the bottom. And so if this were typical, you'd see a retesting of the low later on this year. Given the amount of stimulus that's in the system, I'm not necessarily sure that it'll work exactly the same time this time around. But your average bear market sees a 38.5% decline from the peak, and that would put the market at around 2100. So we didn't quite get there. There's a chance we'll get there again, but I'm hopeful we won't. But the good news, I would argue, is that I think we've done a lot of, unfortunately, we've already done a lot of the damage. So the chances of going a lot lower than that, in my opinion, given the policy response, are quite low. I know it probably seems a little too early to be thinking about the other side of this, but when we've looked in the past at the last nine recessions, we've looked at the industry groups that did the best coming out of the recessions, and there were six of them. So I'll read them quickly, but first is entertainment, second is aerospace and defense, third would be airlines, fourth, metals and miners, fifth, consumer finance companies, and sixth, truckers. So those aren't, it's not a bad list, I think, given the depth of the recession that we're going to have, to see when you do get on the other side of this recession, those could be the companies that lead us out. Technically, the market, I would argue, is looking better for those who follow a lot of charts. The good news is that it does look like the indiscriminate selling that you saw 2 weeks ago has largely stopped. And that's often what happens when you have a situation like this, when there's real liquidity concerns. People don't sell necessarily what they want to sell, they sell what they can sell. And that was very much a part of the program a week and a half ago, where some of the best assets were being sold first because there were actual bids on them. Right now, that seems to have abated quite a bit, and financial conditions seem to have improved. So that's good news. The last thing I'll point to would just be thinking from a very long-term perspective about this, before I turn it over to Don. And it's easier to find the losers than the winners. But from my perspective, the losers from this conceptually, thematically, longer term would be, number one, China as a brand, I think is taking a big hit. If companies weren't thinking about diversifying their supply chains last year during the trade war, they're certainly thinking about doing it now. Two, I think globalization has also taken a hit. And I think Europe is going to be very instructive in that regard. There are real tensions and strains that are evidencing themselves with the Eurozone, which is a very big, obviously a very big social experiment to begin with, very well reasoned and very well intentioned, but still there'll be some very big strains there. I think it's important to think, if you think as I do, that growth was better and inflation was lower because of globalization. I think it is important to think about the idea that to the extent to which we have less globalization in the future, it could have an impact on global growth and global inflation. Third point I would just make is that for those of you who have been following the presidential election and Bernie Sanders, one of the things that he talked about was this idea of modern monetary theory. And modern monetary theory, it's a little complicated. Basically, it's the idea if you have the reserve currency, you can spend whatever you want. And personally, I think it's kind of a crackpot idea, although we could get away with it for a while. But like it or not, this is a form of what we have right now. We are spending an awful lot of money we don't have. I think it's appropriate, personally, right now. The question will be longer term, whether when things stabilize, we'll be able to pull some of the stimulus back. And that'll have a lot to do with whether we wind up getting inflation out of this or not. So short term, this is very deflationary. No two ways about it. I wouldn't worry about inflation for another couple of years at least. By the same token, we're expanding the Fed's balance sheet pretty dramatically and spending a lot of money we don't have. And the dollar's still strengthening, but eventually that could be one of the reasons why gold has been a bit better. But let me stop there. That's about 10 minutes. And let me turn it over to Don to see some of the things he might have to say.
Okay, thank you, Jason. Let me back up, take a bit of a global perspective and try and hone in on a couple of the economic series that we're watching to gauge what happens next. So if we think back to the fourth quarter, we were already seeing some weaker economic data out of Asia. Japan GDP in the fourth quarter turned negative as the value-added tax was increased there. But there wasn't a clear sign of this disruption until we got into the first quarter and saw some of the data from China. The February data on manufacturing from China were very weak, as that's where the virus first started, and that's where you saw the first lockdowns. initially that looked more like a supply chain concern. We weren't going to have products moving through the supply chain that could be modeled like the Fukushima earthquake was a decade ago. But as the virus spread out of China, and I'd say one of the biggest inflection points was the weekend where you saw the virus spread to Iran and Italy and Korea, it became clear that lockdowns were going to be necessary elsewhere. And so the issue with the supply shock became a much bigger global issue in terms of a demand shock. So up until that point, even some of the current economic data is not really reflecting that demand shock yet. So the payroll employment report, which came out at the beginning of March, showed a February increase in U.S. non-farm payrolls of 273,000 and the unemployment rate falling to 3.5%. So before the lockdown, things were actually looking quite solid in the U.S. economy. But because it was a novel virus with no drugs and no vaccine, the only tool we have is to have people separate, to shut down economic activity to allow time for doctors. So this is what a recession by fiat looks like. It's a health lockdown that was taking an economy that even as of early March was still functional in the US and elsewhere and asking it to close. Now, there was another shock that developed pretty quickly, which is as demand started to ebb in the energy space, Russia and OPEC got into a disagreement, so there was no longer any support for oil prices, and you saw a collapse in oil prices after that. So we're considering that economic contagion in the sense that that did not have to happen. It happened because you had some of these virus issues in China getting into the demand picture, and this is an additional shock, we would say, on top of just the health-related shutdown. So there's some timely data that's reflecting the shock. If you look at PMI measures out of the Euro area, out of Japan, if you look at some of our survey work that we do of manufacturers, the very timely data is showing a reduction. And in the service part of the economy, you're seeing that as well. There's a booking website, Open Table, which looks at restaurant bookings. And we see some numbers in there for some locations that are down 100%, depending on the extent of the legal affairs around that area. And so we have seen the timely data look weaker. We expect more of this to come. We may not see it in the March employment data just because the payroll employment number is going to be reflecting the week that contains the 12, but we've already seen it in weekly jobless claims. And this was released in the US last week. We also saw similar numbers in Canada as well as the UK. And so we surged to 3.28 million jobless claims, which is the highest number we've ever seen by a large factor. And so in that regard, even if the March payroll employment report does not show a big problem, it's likely coming. If we factor in about 3 million layoffs, that 3.5% unemployment number that we have could easily turn into something about 5.25% in future months. And given that unemployment is a lagging economic indicator, we're probably looking at a 7% unemployment rate in the near future. If we have a continued surge in jobless claims, that number could be double digit for a short time as we work through this. That's one of the things the fiscal stimulus is aimed at reducing. If we look at the exposure, if we look at the number of employees in food service and drinking places, there's about 12 million employees there and about 17 million US employees in the leisure and hospitality sector. So layoffs still look like they're accumulating. If we look at GDP exposure, we have an economy in the US of about $22 trillion, and there's about 154 billion in general merchandise stores, 684 billion in transportation, 903 billion in arts and entertainment, and 311 billion in mining. And so adding that all together, of that 22 trillion, it looks like there's about $2 trillion that's at risk of taking a significant hit. So that's a health policy decision that these things need to be shut down for some period of time. And so given that, there now needs to be an economic response to try to patch this, and it has been done in a number of regards. The fiscal stimulus package took through last week to develop. I'd say this is pretty fast by DC standards. It's a little late for what the economy probably needed. In other words, if we were really going to avoid that 3 million print on jobless claims, we probably needed the fiscal stimulus bill, the big one, to pass at the same day the NBA shut down. But still, by DC standards, a couple weeks is not too bad. So there was the first bill focused on immediate healthcare needs, the second bill focused on individuals, and then this third bazooka bill, which also provides individuals and companies some aid. In addition to that, the Fed has been very active. Other central banks have participated as well. But the Fed has really been the leader here, taking several emergency steps and now holding interest rates effectively at zero. They've issued some guidance that they could stay there. They've taken the step of more bond purchases. They've opened swap lines with foreign central banks. They've encouraged use of the discount window. They've changed reserve requirements. And then importantly, they've also started to use what's been called the alphabet soup of policies. These are funding facilities for special areas. So we had the CPFF, the commercial paper funding facility, the PDCF, the primary dealer credit facility, the MMMF, the money market mutual fund facility. And so these were things that were created around the 2008-2009 recession to really target liquidity into certain areas. And it's somewhat fortunate we had these on the shelf. So it took months and months back in 2008 to figure these out, to figure out how to do it legally, to get the authority in the right documents. And so here they were reactivated. So they were already on the shelf, and we chose to pull them off the shelf. In addition to that, over the past 2 weeks, we expanded some of that alphabet soup into spaces like the muni market and parts of the corporate market. So the alphabet soup is now helping not just commercial paper, but also munis, also big and small businesses. And there's been the discussion of having a Main Street funding facility to allow that to get to small businesses more directly as well. So we're very happy with the liquidity response. We're less worried about the big liquidity problems that we had in the financial system. There's still a few holes. If we look at commercial real estate, we're going to come up this week on the April 1st date, which is going to require rent payments. It is unclear whether retailers are going to be forthcoming. Some probably will, some won't. We're going to see how this goes. If you have tenants saying, look, I'm closed down, I'm going to withhold rent into contract law, there is an ability when you have agencies involved on the other end to offer some flexibility. We're mostly worried about the non-agency commercial space. And so that might be an area where you need some sort of direct targeting. That's one thing we have not addressed with the current alphabet soup. But for the most part, the liquidity facilities are helping with spreads. They're just not helping a business that has lost a month or 2 months of revenue stay solvent. And that's where the fiscal policy response has to take hold. And that's why this may not be the last bill that we see on the fiscal policy side. We may have to take stock of where we are in a month, see exactly how many people remain on payrolls, and make some judgment there. The goal of the stimulus altogether is to try to keep individuals on the payroll of the company that they're on. So to say to a business, keep people on your payroll, will provide you some funding to do that, even if the store is shut down for another 4 weeks or so. So this is using as a base case assumption that the ability for the economy to reopen is somewhere in the next several months. We think that that's the right story here, but that's going to be a call by the health officials, and that's going to determine what the next economic response, if any, is going to be. But right now, the economic data is likely as a package to get worse. We've already had a few highlights here, like the jobless claims number, and we're probably going to get continued negative prints for quite some time here. It's the stimulus on the other side that's offering the offset. So why don't I pause there, and there may be a couple questions we can help address as well.
Jason and Don, thank you. This is Marty Brainerd from Westwood. In the interest of time and due to some operational constraints, we're not going to open it up to Q&A, but I do have a couple questions that I've received from clients of late that I did want to ask. So Jason, I'll start with you. How much of the recent price action, i.e. the big up days and the big down days, has been driven by high velocity, momentum, and algorithmic trading?
Well, the simple answer is we don't know, but my suspicion is that it's an awful lot. And I feel quite strongly about this, that when the dust settles here, there's going to have to be a real reevaluation of market structure, because before this started, the total value of U.S. stocks was about $30 trillion. Now, of course, this is an extreme situation, but a $30 trillion market shouldn't lose a third of its value in 2 weeks. And some of the intraday moves are pretty substantial. So there's been talk. We've talked to people at the administration about this. I mean, there's been some talk about reinstituting the uptick rule for short sales. There are some people that say it wouldn't help all that much, but in my opinion, it couldn't hurt. I'm not a big fan of taxes in any way, but there's been some talk of the Tobin tax, which would be a tax on very short-term investments. And by meaning short-term, I'm meaning things that are happening in hundredths of a second. Or and I'm not, as someone who loves the financial markets and think they represent a very important role, I can't see it in any way how that would hurt capital formation. So I'm not a big fan of shutting down the markets. I'm not a big fan of suspending short sales. But by the same token, I do think the primary purpose of the capital markets is to help companies and municipalities and governments raise capital, and it's not to become a casino. So it's hard to know precisely what the impact is, but it seems, as somebody who's been doing this for about 30 years, it seems pretty obvious to me that there are some real structural problems in terms of market structure.
Thank you. And with that said, I'll position this to either one of you to respond. How different do you think the U.S. markets are from both Europe and emerging market space during this time? How far ahead or how far behind?
Well, I might just hop in for 1 second, Don. I'll take maybe the European side. One of the things I have to say going into this year, I was actually pretty bullish on Europe, and the reason why I was that Europe, in many ways, in my opinion, was one of the biggest losers out of the trade tensions between the U.S. and China, and that's largely because of the nature of European economies. It's much more export oriented than the United States, and it's much more dependent upon trade. And so I was expecting some sort of detente between the U.S. and China to lead to stronger European growth this year. Right now, it seems to me there's going to be a real reevaluation of China as a source of supply chains. And I'd also say, as I mentioned in my prepared comments, I think Europe is going to have some serious problems internally. It was already close to recession before this, and is going to have I think is going to have very meaningful political tensions within the union itself, which will make trade a little bit harder to get through. The U.S. is a big economy. It's pretty diversified. Italy, as an example, is much smaller. It's about 1/6 the size, 1/5, 1/6 the size. It's completely shut down. And if you're paying attention to the fiscal policy responses in comparison to the United States are not even in the same order of magnitude. I mean, and it's partly because of some of the EU rules and the rest. And so they've completely shut down the economy, and yet they're really shooting a BB gun or something where you need an elephant gun to help out. And so I think they're pretty far behind on the economic response. Would be my own opinion. I don't have a strong opinion on the developing markets, although it stands to reason that, given the extent to which they're levered to the developed markets, that they might not have as many of the health problems, perhaps, but the economic solutions are pretty far off. Don?
Yeah, I might just add, the China economic data did fall first. So if you look at things like the Purchasing Managers Index, that went down first. There is some evidence in the China data that they might be trying to bottom after some very bad readings. If you look at industrial production or retail sales, you've had awful numbers there. Now, maybe that's some sort of bottom for them. I think that the challenge is, how do you invest in that, especially if you're a U.S. investor, because what we've seen is the U.S. dollar hang in there in terms of dollar strength, despite some of the fundamentals, big budget deficit, big trade deficit, Fed easing. And so to really get the emerging markets investable, we'd like to think about having a U.S. dollar peak, but that probably requires a return to some sort of global growth profile. So China's not completely out of the woods as an export economy, or at least that part of their economy is not out of the woods until you have a return to global growth. So even though some of the economic data in China might be not getting worse, and maybe in some cases getting a little better as they start to return some of the factories into production, it's a question of where those goods are going to go if their customers are shut down for another 4 weeks or whatever the appropriate timing is going to be. So we've created an integrated world, and it's still integrated. Maybe that's something that changes, but it hasn't yet.
Thank you. And in the interest of time, just one more question, and this is for either of you, your opinions. What are the implications of this crisis for the November elections, or is it simply too soon to tell?
Well, I could hop in here pretty quickly and then defer to Don. We were watching the Gallup polls. The first thing I would say is I think it's too early to tell. The second thing I would say is if you look at the Gallup polls, President Trump's approval ratings are actually at the highest level of his presidency. And so I would argue one of the problems 2 months ago, in my opinion, is that the investment community, generally speaking, was almost universal in thinking that Donald Trump would be reelected in November. And the reason why that bothered me, just from a contrarian point of view, is that it is a 50-50 country, and it's, regardless of the circumstances, it's going to be, it's just by definition, it's likely going to be a close election. And so I thought that was an issue before coronavirus started, just that there would be just given the nature of our politics, this would be better than people thought. Clearly, expectations of President Trump being re-elected have come back in to I think, a more acceptable, normal view of things. But I would say so far the numbers bode well for him in November. But obviously, how the virus and his continued response to the virus will have a lot to say as to how that works. I would just say, generally speaking, competent incumbents should benefit from this, partly because they have the bully pulpit, and you're seeing them so frequently, and they're being seen as, generally speaking, strong leaders. And so even someone like Governor Cuomo, who I have to say personally I'm not a huge fan of, for a variety of he's become a little bit of a superstar here in New York, and I'm not sure Donald Trump has the same ability to kind of convert people over, but this is one of the powers of incumbency, I would just say. So I still kind of give Donald Trump the edge as far as November is concerned, just asterisking the idea that it's in politics, 6 months is an eternity. So,
hey, Jason, one thing I might add is if we look at history, it says the second quarter economic data is important for thinking about how an incumbent can do. And the second quarter is going to look terrible in most of the economic metrics we typically monitor. And GDP could be down double digits. We're estimating down 10% quarter to quarter annualized, simply because we have chosen to shut down large areas of the economy as an appropriate health response. So this is a little different than other things that would cause an increase in unemployment if it's believed to be temporary because of some other reason. Perhaps there's some difference, but the historical correlations aren't going to look very good, at least. So it's going to have to come out of some other variables to make that determination.
Gentlemen, thank you for your time. Thank you for your comments, and thank you for your partnership. We definitely appreciate it. For those that called in, if a topic or question came up, please reach out to your advisor and we will work to get that question answered. Otherwise, thank you for participating. And we will also be putting a recording or a link to the recording of this discussion on our site, and we will share that communication with you very soon. Otherwise, thank you. Have a great day. And again, appreciate everyone participating.